You were told your money was safe. The bank was solid. Regulators were watching. Then one morning in March 2023, depositors woke up and the doors were locked. Silicon Valley Bank was the 16th largest bank in the United States. Over $200 billion in assets. Considered modern, stable, and well managed. It collapsed in 48 hours. The second largest bank failure in American history. Here is what actually happened. During the years of near zero interest rates, the bank took billions in customer deposits and invested heavily in long-term government bonds. On paper, this looked safe. Government bonds are considered low risk, but long-term bonds carry a hidden danger. When interest rates rise, the market value of existing bonds falls because new bonds are issued paying higher returns and nobody wants to buy the old ones at face value anymore. In 2022, the Federal Reserve raised interest rates at the fastest pace in over 40 years to fight inflation. The bond Silicon Valley Bank was holding lost significant value. The bank was sitting on billions of dollars in unrealized losses. As long as nobody asked for their money back, the losses stayed theoretical. The bank could keep operating as if nothing was wrong. But word started to spread. A small number of prominent venture capital investors who represented many of the bank's largest depositors began quietly advising their portfolio companies to move their money elsewhere. The warning spread through private networks first, then publicly. What followed was the fastest bank run in modern history. Depositors withdrew $42 billion in a single day. The bank did not have anywhere near enough liquid cash to cover it. Here's the part that should concern you most. The bank's own executives understood the risk their bond portfolio carried well before depositors did. Securities filings later showed that senior executives sold company shares in the weeks leading up to the collapse. The chief executive sold shares worth millions just days before the bank publicly disclosed its financial troubles. By the time the wider public understood what was happening, the people closest to the problem had already protected themselves. When the bank failed, the Federal Deposit Insurance Corporation only guarantees deposits up to $250,000 per account. The vast majority of Silicon Valley Bank's deposits belong to startups and venture funds holding millions of dollars, far above that insured limit. To prevent a wider panic across the banking system, the government took the extraordinary step of guaranteeing all deposits at the bank, insured or not. This decision was made over a single weekend by regulators who judged that letting uninsured depositors lose their money would trigger runs on other banks across the country. The cost of that guarantee was ultimately absorbed by the broader banking system and indirectly by the public. Meanwhile, the executives who built the risk into the bank in the first place faced no criminal charges. Some had already sold their shares at a profit before the collapse became public knowledge. This was not a sudden, unpredictable accident. It was the result of a specific decision to chase a yield with depositor money during a low interest rate environment, combined with a failure to manage the obvious risk that interest rates could rise. Regulators who were supposed to catch this in routine examinations did not flag it in time. The pattern is familiar. Risk gets concentrated at institutions considered too important to fail. When the risk materializes, the people who created it walk away largely unharmed, while the cost lands on depositors, the broader financial system, or the public purse. Silicon Valley Bank was supposed to be safe. The system was supposed to catch this before it happened. Neither protection held when it mattered.